use your credit card to buy something. When you swipe or tap your card at a store, the bank that gave you the card pays the store right away. But wait, why would the bank pay first? Because they want you to keep buying things with their card and then pay them back later. So, the bank gives you a loan for that purchase. Now, here's where the bank makes money. The store doesn't get the full price of your purchase from the bank. Instead, the store pays a fee to the bank. This fee is called the merchant fee or interchange fee. It's usually a small percentage of the purchase price, often around 1 to 3%. So, if you buy a $100 item, the store might only get $97 or $98 because the bank keeps a few dollars. Why does the store agree to this? Because accepting credit cards means more customers and bigger sales. For the store, paying a small fee is worth it if it means people buy more. For the bank, this fee is a steady source of income every time someone uses their card. Next, let's talk about interest. If you don't pay your full credit card bill by the due date, the bank charges interest on the leftover balance. This interest rate can be quite high compared to other types of loans. When you carry a balance, the bank earns money from this interest every month. This is one of the biggest ways banks make profits from credit cards. But what if you always pay your full bill on time? Are banks losing money then? Not really. Banks also make money from annual fees on some credit cards. These fees can range from a few dollars to hundreds of dollars per year, depending on the card's perks. So, even if you pay your bill each month, the bank still earns money from that fee. Banks also earn money from late payment fees. If you miss a payment or pay late, the bank charges a penalty fee. These fees are usually set amounts and can add up quickly if you keep missing payments. On top of that, if you go over your credit limit, the bank might charge an over-limit fee. Another way banks profit is through cash advances. If you use your credit card to get cash from an ATM, the bank charges a fee plus a higher interest rate on that cash. This is one of the most expensive ways to use a credit card, and banks count on these fees and interest to boost their earnings. Some credit cards offer rewards like points, miles, or cash back. You might wonder how banks can afford these rewards. The answer goes back to those merchant fees. A part of the fee the store pays helps fund the rewards you get. Since more people use the card to earn rewards, banks make more money from merchant fees and interest charges. Banks also use your credit card data to create offers and promotions. They may partner with stores or companies to encourage you to spend more. When you use your card with these partners, the bank often gets a bigger cut from the merchant fees or other payments. This helps banks increase their income while giving you special deals.